If exit plans for your cannabis company include going public, then you really need to take financial audits seriously, because without completing your audits, you're likely never going to make it past the dreaming of going public phase. In a previous video, we set the groundwork for understanding the audit requirements for cannabis companies looking to go public, and I'll review that in just a moment, because in this video, we're going to cover what, if any, acquisitions need to have a full audit performed and how in-depth those audits need to be. Now, if you need help with going public, performing those audits, or confidently closing your M&A deals, then please schedule a free consultation with our team by visiting our website at greengrowthcpas.com or give us a call at 800-674-9050. Let's jump right in. Let's do a quick 40-second review of the previous video. All companies planning to go public will need to submit an S-1, which includes historical financial performance information, including audited financial statements. Typical private market due diligence standards are very subjective, but audit guidelines of public companies are much more strict and set by the SEC. A lack of sufficient data and records to back up your audits can significantly hinder the audit process, if not stall it out completely. There are two types of acquisitions: asset acquisitions and entity or business acquisitions. Now, asset acquisitions typically do not need to be audited, but business acquisitions will likely need to be audited depending on the significance of the size relative to the parent company. Now, you need to be aware that some asset acquisitions can become business acquisitions. And the key with asset acquisitions is that sometimes they look like a legally structured asset acquisition, but are still subject to an audit. For example, say you purchase a cannabis manufacturing facility with employees. Now that business, it files its taxes as an LLC, and all the assets are neatly contained within just one LLC. But making a simple update like the change of ownership on paper from the previous owner to the entity that you own can impact the necessity for an audit. This is because even while the manufacturing facility that you purchase may continue to operate separately on its own with independent resources, you now have an ownership stake which will drive financial impact to the parent company. So from an accounting perspective and the view of the SEC, it's a business acquisition. While yes, you are purchasing all these assets that are neatly bundled into an LLC, it's important to realize that those assets operate and again produce a financial impact on the parent company that's filing to go public. However, the size of the economic impact on the parent company will help you to determine if an audit is required and how far back that audit needs to go. This brings us to significance tests for audit requirements. Now, there is a series of tests to help you determine if an acquisition will be subject to an audit when you go public. These significance tests include an investment test, an asset test, and an income test. Each of these tests is applied when determining if the acquired subsidiary meets the regulatory requirements for an audit, and the ratios help owners like yourself identify the level of significance on the business overall, which then determines the depth of the financial reporting requirements. So let's talk about running these tests. We're going to look at an ongoing example reviewing each of these tests. And note that the numerator and the denominator components for each test is pulled from the SEC regulations. First, we have the investment test, and you can see the numbers needed for calculation on your screen now. Say you have a parent company that has a market value of $21 million, and you made an investment to acquire another business for $3 million. Your investment ratio is calculated as 3 divided by 21, which comes out to 14.3%. Next, we have the asset and the income tests. And for these tests, the SEC recommends using data from the end of the most recently completed fiscal year when calculating the numerator and the denominator accordingly, which you can see on the screen now. And for the asset tests, say you acquired that same company from the previous example and the assets are worth $2.8 million and the parent company's total consolidated assets are worth $10 million. Your asset ratio is calculated as 2.8 divided by 10, which comes out to 28%. And lastly, we have the income test, and you can see the components on the screen now. So let's look at an example, continuing with that same deal from the previous two tests. That same acquired company's revenue, say it's $8 million, and the parent company's total revenue is $16 million. Your income ratio is calculated as 8 divided by 16, which comes out to 50%. So now that you know how to calculate the ratios, let's look and analyze the significance test results of our example And the table on the screen summarizes the financial statement reporting requirements based on the level of significance of that particular acquisition. And in plain terms, after calculating the significance ratios from the 3 tests, you can determine your obligations to produce audited financial statements for each acquisition. And depending on the threshold you reach for any of these tests, here's what to know. Less than 20%, no financial statements required. 20 to 40% significance, 1 year of the most recent fiscal year audited plus other unaudited financials. And if you're at 40% or higher, audited financial statements for the most 2 recent fiscal years plus some other unaudited financials. So for our example test results, you see them on the screen now. We would hit the highest threshold of over 40% significance in the income test, and we would need audited financial statements for the past 2 years of that acquisition plus other financial paperwork. Why is it that any test can trigger higher requirements? Why don't we look at an average of the tests? Well, it's because you may be able to sandbag 1 or 2 of the tests, but the 3rd test will show the true economic impact on the company, and in turn, that will impact public shareholders. Looking at the ratios from our example on the screen, I want to give some thoughts and context around this example acquisition and why we look at each test individually and only 1 test can increase those filing requirements. First, let's look at the investment ratio. For this transaction, what if you got a great deal on the business that you acquired? Maybe you got a huge discount, a sweetheart deal. Or maybe you wildly overpaid if you look at it on the other angle because of an emotional purchase caused by limited licensing hysteria. Now, for the asset ratio, maybe the company that you're acquiring has a very healthy intellectual property portfolio that could have major implications for the parent company, such as increasing the ability to sell under highly regarded brand names. Or maybe there's a real estate portfolio that can significantly reduce your rents and increase the net income of the parent company. And lastly, looking at the income ratio, maybe you have low sales as the parent company and you're buying businesses with huge sales to add to your top line revenue. Well, the SEC wants to look deeper into how sustainable those revenues are and how that trickles through the business because it will impact public shareholders. So to summarize, if the financial impact wasn't above 20% significance on any of those tests, then you're likely off the hook for additional audits, but consult with an experienced audit group like Greengrow CPAs. Otherwise, you have some auditing requirements and you want to get those audits done as quickly as possible because they take a lot of time, and doing them under a tight timeline can increase the cost and delay your public listings. Now, thank you for taking the time to watch this video, and I hope it's brought you some value and understanding around the needs for audits for cannabis companies looking to go public. Now, if you need help with going public, performing these audits, or confidently closing your M&A deals, then please schedule a free consultation with our team by visiting our website at greengrowcpas.com or give us a call at 800-674-9050. Have a great day, and we'll talk to you soon. Please note that the information contained in this presentation is meant for guidance purposes only and not as professional legal or tax advice. And further, it does not give any personalized legal, tax, investment, or any business advice in general.